The ordinary Indian works very hard. They don't want to become Warren Buffett or Rakesh Junjunwala, whatever it is. Money means so much. Today there was some data saying that mutual funds are now 30% of bank deposit. I think what you've got is the best of both worlds with SIF.
So essentially, it's like an arbitrage in the mutual fund space.
If people think SIF is magic, it's not. To generate maybe 8% post-tax returns, that platform needs to deliver about 15, 16. Now, don't ask me a mean question.
It is to do with the Aam Aadmi and the
Aam Janta, man and woman both.
Salve et benevenisti, nomen mihi est Alex Matthew. Didn't understand what I just said? Well, I don't blame you. That was Latin. What I said was, hello and welcome, my name is Alex Matthew. That feeling of not understanding is familiar, isn't it? Financial products are often similarly difficult to understand. And just when you think you're getting a handle of things, something new gets introduced, and you're back to square one. This is MoneyWise on NDTV Profit, and today I'd like to talk to you about specialized investment funds. And don't worry, we're not going to be talking about it in Latin. Joining me today is someone you'll recognize. Radhika Gupta, Managing Director and Chief Executive Officer at Edelweiss Asset Management. Radhika, pleasure, as always.
Thank you. That was a rather creative introduction. Well done.
I'm glad I had to learn a little bit of Latin.
Yeah, I can't tell if you did it well or badly because I don't understand
See,
Latin.
that's the trick.
But you get points for creativity, and that's what counts.
But isn't that the trick? And with financial products as well, the attempt, of course, here is to make things easy to understand. And I don't think that we're doing anybody a disservice. I think a lot of people tend to complicate things unnecessarily to appear smarter. Do you think that that's the case?
You know, every time, and I meet so many people, every time someone tells me, मुझे finance समझ नहीं आता, or money is too complicated for me. They could be rich, poor, man, woman, north, south, whatever. Like, a part of me feels very, very sad because I don't think it's their fault. I think it's our fault as an industry. So I don't know if we're intentionally doing it or unintentionally doing it. But I think fundamentally what we do is very good. The financial products, there are good financial products, and finance means, money means so much.
Independence,
confidence, dreams. There's so much that comes. The emotional angles of money are so strong that I almost feel we have a duty to simplify.
We've been doing not just us as an industry, but the mutual fund industry has been, and the asset management industry has been doing some good work. Mutual Fund Sahi Hai, there have been several campaigns out there to educate people about, and you've seen the effect of that. We're seeing it this week where globally this turmoil is taking place and people are talking about buying the dip. Do you think that you can take a little bit of credit for that?
I think we can take lots of credit. Look, I think Mutual Fund Sahi is a landmark campaign. I mean, it's worthy of a Wharton or Harvard case study because I don't think in any part of the world, in any industry, certainly financial services, have people who are competitors willingly come together, pool their own money, and it's a lot of money. It's 1 basis point, 600-700 crore rupees for the purpose of investor education, and that's what they do at AMFI level. What we do at industry level is a lot more. And you know, today there was some data saying that mutual funds are now 30% of bank deposits. I think a decade ago we were sitting at 13%. 13 to 30 or whatever that is, that's a big gap. This is a good product with good regulation and the right amount of advocacy doing good for consumers. So I think we can take some credit for that.
Okay, so now that's the mutual fund space, which is, there's a product for everybody. And it goes from people who are investing 500 rupees to 1,000 rupees, a few thousand rupees, all the way to crore plus, right? So now we're getting into a situation where you're trying to create another product. And that's essentially what I want to start with today, which is that specialized investment fund. How is this going to be different? And a lot of this has been discussed already, but I want to break it down right to the nuts and bolts because you've got a product out there. At least you've
we've got brand approval, yes.
You've got brand approval. So tell me about that.
So I would say this, and let's attempt to kill the Latin here.
Yeah.
There was a house called Mutual Fund, and it was a house that provided and catered to very basic needs. It did it exceptionally well, and that house was really open to everyone from 100 rupees upwards. It had a set of rules that are very, very transparent. It was just loved. And of course, because that house catered to everyone, it had a set of investment restrictions and less flexibility, rightly so, because anyone could walk into the house. On the other hand, you had two other managed products, AIF and PMS, two other houses.
Alternative
investment funds, and they have multiple categories and portfolio management services. I would call them two different houses. And they had more investment flexibility, but of course they didn't cater to anyone. PMS starts at a ticket size of 50 lakhs, alternative investment funds at 1 crore, but they had more investment flexibility. I think what you've got is the best of both worlds with SIF. You get some of the investment flexibility that the AIF or PMS accorded you, but you get the rules, the transparency, the taxation structure, and we can talk about all the rules of the house, of a mutual fund, the convenience, the SIP, and guess what? You get to enter at 10 lakhs. So I think the flexibility of the AIF and PMS house with all the platform and the rules of the mutual fund house and more accessible. And I think it opens the ambit to a much wider consumer base. People are not realizing this, but when you talk to a consumer who's giving you 1 crore, that's someone with a 10 crore net worth. When you talk to someone who's giving you 10 lakhs, you're talking to someone with a 1 crore net worth. That's an exponentially larger population.
Yeah. And also, it's a pool of investors that is growing by the day. The 10 lakh and 1 crore reference that you had, and also they're going to be looking for more differentiated products. So one thing that I want to establish right at the start is that it's not an either or game, right? So you could have a traditional mutual fund investor that is putting a portion of his or her portfolio towards this SIF, and you won't have somebody who's only investing in SIFs, right?
No, that certainly should not happen. And the danger of all this, there's all these good things that are going to come out of SIF. But if people think SIF is magic, it's not. SIF ideally, because of the flexibility it gives you, should be able to provide you with solutions, asset classes, or risk return profiles that are not available on a mutual fund. So I would say 70 to 80% of your needs, your dal chawal, will still be well served by a mutual fund, but some very interesting things that are just not enabled on a mutual fund will be served on SIF. If SIF is serving you what mutual fund already served you, there's no point of SIF.
Exactly. So let's talk about you as a fund house. The name of, first of all, it needs to be a distinctive name. It cannot be Edelweiss Mutual Fund. So one, what is that name? Two, you've gone out and sought approval for a couple of the products that are available to be launched. What are they and why have you launched them?
So we've launched the brand Altiva. I think I love the idea of a distinct brand name, firstly. And the idea of Altiva was altitude. It's something for a more aspirational set of consumer. It also links beautifully to Alpine, and Edelweiss, the flower, grows in the Alpine.
Oh, I didn't catch that.
And finally, Altiva, it is an alternative product. So the link I said between mutual fund, AIF, and PMS, I think nicely comes up. So hence, Altiva is a name with many meanings. There are, as far as product launches, we filed for one product with SEBI. Today, the regulator has allowed seven categories of funds in 3 meta categories: equity, hybrid, and fixed income. We filed our first fund in the hybrid category, and we're hoping we'll create a solution that provides investors risk-adjusted returns, maybe more tax-efficient fixed income solutions.
Okay. So before we get into the categorization and how each of these is going to work, what are the timelines we're talking about, Radhika? Of course, it would be pending regulatory approval, but I'm talking about launch, etc.
I think it's all pending regulatory approval. So as I understand, a few of us have got brand name approval. I know we filed for a product. I know multiple others have filed for a product. I think the first set of product launches will take time because even, to be fair, from a regulatory point of view, There's a set of checklists that need to be maintained. There's a set of harmonization that needs to happen. It's a new industry, so all those checks need to be in place. But I'm hoping that we'll have a product out in the next couple of months.
A
It shouldn't be
couple
far,
of months.
Shouldn't
Okay.
be far away.
Okay. So now, so we see that the first product, as you pointed out, there's equity, there's fixed income, and there is hybrid. And you've chosen the hybrid route. From my initial reading of how these are going to be structured is that there are the similar options in each of these overall, as you've called them, meta categories,
Yeah.
asset classes. So can you describe how each of these will work broadly?
So I'll break it this way. What is the flexibility? Because otherwise this becomes very confusing. What is the flexibility that SIF gives you? And then how do the categories map compared to your regular mutual fund? Because we all understand there are three flexibilities broadly that SIF gives you. One is the use of derivatives. In mutual funds, you can't use derivatives to take negative views. If I buy 50 shares of XYZ company, I have to sell 50 shares. I can't sell 50 shares of ABC company, right? So it's derivatives is flexibility. Second flexibility is around credit usage. In fixed income, you can be more aggressive with your credit use. And third is you don't need to have funds with daily redemption. That's a big change for mutual fund because mutual funds mean daily redemption. There are some categories which allow you weekly or bi-weekly redemption. Hence the flexibility on credit, because credit is not liquid. Sometimes derivatives are not liquid. With that, what happens? So you have equity, you have hybrid, you have fixed income. You understand these three categories from mutual fund. In each category, you have subcategories. So let's take equity. You have a category called equity long short. I would say this is your mutual fund flexi cap category with derivative flexibility.
So, but just to drive home that derivative part,
Yeah.
so that people understand it, we're talking about, and we'll explain it, hopefully you'll explain it, naked shorts are available, right?
To the tune of 25%.
To the tune of 25%. This is effectively when you think that there is equity in the market,
Yeah.
and you anticipate that the prices will fall. You
Yeah.
want to benefit from that fall, and so you take a derivative position which is unhedged.
So as an example, I may say, I think manufacturing and IT stocks are going to do well. So I'm going to put 35 rupees in manufacturing and 40 rupees in IT. That's 45 rupees. And I think financials are going to do badly. I'm going to do minus 25 in financial stocks. That's a portfolio that you could create. It's not the only portfolio you could create. You don't have to always be short, but it's just one way you could express a view.
Okay, and the alternative, just to drive home that point, as you pointed out in the flexi cap category, you can still take derivatives, but they need to be balanced. So
Yes.
you could have financial, which you're long on, financial, which you're short on, and they have to net each other out.
And the same stocks.
And the same stocks.
So they all have to net each other out. So I can't really take a negative view on a certain bank.
Right.
Because it has to net itself out.
So essentially, it's like an arbitrage in the mutual fund space, which we're talking about. You can have some elements
Yes.
of arbitrage, and you use arbitrage
All
quite
of
a
us
bit.
use arbitrage in our arbitrage funds.
In your multi-cap, multi-asset
In our
funds.
multi-asset funds, in our balanced advantage funds, in our equity savings funds. All of us are doing arbitrage. All of us are hedging, but we're not able to profit from a situation where a stock is falling.
Okay, so this is the equity long short fund. And what are the other categories?
The next one is X Top 100. This is your erstwhile mid and small cap category, again with shorting features.
Okay.
So you have a flexi cap category that you can now shorten. You have a mid and small cap category that you can now shorten. And then third, you have a sector rotation category that you can now shorten. So I had business cycles equivalent in mutual fund. I can do sector rotation, but there I could only go long on sectors. Here I can also go short on sectors. So equity, 3 mutual fund categories with derivatives.
Okay. And conceptually, I'm just wondering the aggressiveness that a fund manager could potentially take. Of course, this is something that we will discuss in more detail as and when people come to the table with their products. But I'm just trying to understand the risk categorization in these equity products, because you are using naked derivatives or unhedged derivatives, or derivatives to not hedge, shall we call it that. You had the riskometer in mutual funds, which tells you in the form of a speedometer, this is the highest available risk, and most equity is the highest available risk. So how do you distinguish between that and this?
So I think risk is going to get a lot more nuanced. In fact, I hope a lot of channels, advisors, etc., are going to have more conversations about risk, because this category is really about risk-adjusted return. I mean, I think SIF has to teach India risk. Okay. The other thing that people have to remember is, I've been getting lots of questions on what's the return going to be in SIF. No idea, because it depends. Within an SIF, you can build multiple different portfolios. Now, the reality is mutual funds are houses that are relatively similar. A mid-cap mandate basically means the fund manager for the large part will hold 90 to 100% of his portfolio in mid-cap stocks and 50 to 70 names. That's what most people do. So there's not that much difference. Let's take your equity long short category. There can be someone who will build a portfolio that is 75 rupees long, 25 rupees short. There can be someone else, they have net 50% market exposure. So you can do a 75-25, you can do a 50-25.
Right.
So one has 50% market exposure, one has 25% market exposure.
Right.
Now, you can argue, by the way, the 75-25 is riskier. There will be times when your 75 will go wrong and your 25 will go wrong.
Yeah.
So your understanding needs to be a lot more nuanced. Or you can build a 50, you can build a 25-25, that's zero market exposure.
Yes, and in the hybrid and the fixed income space, it actually gets even more nuanced,
Yes.
right? Because, and by the way, as I understand it, please correct me if I'm wrong, hybrid as well, you will have a similar subcategorization.
So you have
right?
two products. You have a hybrid long short and a multi-asset in hybrid. Now,
Yeah.
there I have debt, I have equity, and I have commodity. And I can go long on these asset classes, I can
you
go
can go
short.
short.
So these are like your multi-asset funds in mutual fund,
Yeah.
but I can go long and short.
Okay, so in this, from what I read, debt, as in if you're investing in the debt of a company,
Yeah.
you can technically have much more exposure to a single paper.
Yes.
One single bond. That is, for example, if for example, a PFC, which is a Power Finance Corporation, is issuing a 10-year bond, you can take 20%.
I think it's 20%. And you have more restrictions around lower rated paper.
Sure.
And the good news they've done in debt is, because you have more exposure to a single bond, because you have lower rated paper. See, we've seen in 2018, bond markets and all securities are not equally liquid. When you put pressure on a fund manager to do daily redemption, you have challenges. And without going into them, we've seen some of those challenges. Here in debt, they're saying don't do daily redemption. If the asset class is not that liquid, you also manage investor liquidity. By the way, that's one of the reasons I think the brand name is separate, because mutual fund is now understood as a daily redemption instrument.
So, but the other aspect would also be that these derivative contracts would play out over a period of time. And so
Yeah.
the fund manager would take a certain derivative contract, understanding full well that they won't have to take redemption pressure in a certain window.
Yeah.
Would that be a fair assumption?
So with equity derivatives in India, they are reasonably liquid.
Sure.
So in the equity category, they have said daily subscription redemption
Is allowed.
In the hybrid category, they have said once or twice a week. In the fixed income category, they've said weekly or more than that.
Okay, and
So
that's the
equity
minimum.
doesn't have a liquidity issue.
That's the minimum that is available. A fund house or an EMC can choose to have a
Yeah.
more regular redemption.
Wherever essentially fixed income is inserted, they've said, let's be a little careful. And I think that's all for the good. They've also given more flexibility around REITs and InvITs.
Right.
Again, they're not completely liquid, so that helps.
Okay. So why hybrid for you? Why was that
Yeah.
the first product that you went for?
So one is, look, I think we're going to approach this category differently as a fund house. I mean, we anyway don't do a large number of NFOs on the mutual fund side. But this is not one where you say 7 categories, let's go do 7 NFOs, one every month. We really think each category has to be thought through, figure out the consumer need and figure out the skill set, because the skill set is really very unique. Now, for us, one of the reasons we chose hybrid is we felt that since fixed income taxation had changed, one of the needs of the Indian consumer is tax-efficient fixed income or fixed income-like solutions. Not to take away from equity, but there are a lot of risk products out there. There's MF, in which you have mid-cap, small-cap, there's PMS, there's AIF. If a consumer wants risk, there is risk. I think a crying gap in the market is tax-efficient, fixed income-like exposure, and we think we can create that with derivatives. It's also our skill set.
So I just want to have a small sidebar to tell you what we just spoke about is the taxation on fixed income mutual funds.
Yeah.
And as things stand, because of a change that took place a couple of budgets back, if I remember
Yes.
correctly, you are now taxed. Your returns from those fixed income mutual funds are taxed at slab rate, which is not the best thing, particularly if you're in the highest tax bracket. So, coming to taxation on these SIFs, why is it better than the AIF category in particular?
So I think the taxation structure is fantastic. I mean, mutual funds enjoy two things. One, they enjoy the capital gains rate of taxation. It's 23B, it falls under section 23B. Equity, you know, if it's 65% and above,
Yeah.
it's 1 year. And then there is a category if you're between 35 and 65%.
Which is 2 years and
Which is that
12.5%.
2 years. SIFs have the same rules as mutual funds. Now, in a PMS, if I'm buying a PMS and the fund manager does any churn, I as a consumer pay tax on every churn. Today, short-term capital gains in India is 20% plus surcharge. In mutual funds, people don't pay tax on churn. They don't even pay tax annually. They pay tax when they realize the gains. So this is a lot more efficient to do those kind of strategies than PMS. In AIF Cat 3, if you run, and I've run Cat 3 funds, because you're paying tax at the trust level, the blended tax, if you build derivative products, ends up between 30 and 40%, often at the marginal rate of tax. If I were to do a hybrid long-short product on the AIF platform, the consumer would be paying 40%, that marginal rate of tax, whatever that is. To generate maybe 8% post-tax returns, that platform needs to deliver 15, 16. SIF needs to deliver 11, 12.
Tell me this.
No, don't ask me a mean question.
Does this, I have to ask that, does this sound the death knell for category 3 AIFs?
I don't want to sound death knell on anyone. I think it sounds very large opportunity for mutual fund managers who have derivatives capabilities on SIF. Let me not sound death knell on anyone.
Okay. All right. So, well, it's the nature of the product. We've tried to simplify this as far as possible. Yeah. But having said that, by the way, in case you've got questions on any of this, do not hesitate to write in and we will get this clarified over a period of time. And this is a new product. Of course, a lot will be spoken about it once products get launched. Now, Radhika, I love that I have you in studio because I also want to talk about this this new book that you've written.
Oh, yeah?
It's not out yet. So I have to read it. By the way, this is...
You've not read it.
This
There
is
you go.
Mango Millionaire. I love
Millionaire.
the play on words.
Thank you.
It is to do with the Aam Aadmi. And the
Aam Janta, man and woman both.
Man, Aam Janta.
Aam Janta.
I will accept that correction. But tell me about it. What does it seek to do?
Look, we started this conversation with Latin, and I told you every time someone says money is complicated, I get very sad. And at some point, I said, what are we going to do about this, right? We're in this profession. I've been doing this for 20 years. I've been doing all these conversations with people like you. But can we create something where if you pick it up and feel scared to talk to money, by the end of these 250 pages, are you confident enough to do your first SIP or make your first investment or just be more comfortable with money? We're not writing a book for a stock market wizard. It doesn't have a line on how to pick stocks, okay? It's not a valuation. It doesn't have lines on behavioral finance. We don't need that. It's a dal chawal guide to understanding money for the Aam Janta of India. You know, if you've seen the movie Love Aajkal, and you know I love movies, there's a beautiful line where Saif Ali Khan says that the ordinary lover does not want to become, you know, Heer Ranjha or someone. They just want to achieve love in their lifetime. The ordinary Indian works very hard. They don't want to become Warren Buffett or Rakesh Jhunjhunwala, whatever it is. They just want that their money works hard for them and meets their goals. This is to help you do that.
What is, as somebody who is leading an AMC and is having a different level of conversations in the corner office, what is the biggest challenge for you writing this book?
God, it was to simplify. It was to try and take terminology that is so complicated, like the word asset allocation. I just realized we use it so much. And we've tried to cut down the use of the word asset allocation or explain it. So the idea really as a finance professional, because the jargon sticks in your head, how do you get rid of the jargon? And one, to simplify, but also not to make it Encyclopedia Britannica or an SID, because then it's boring. So we've tried to incorporate lots of storytelling, lots of food examples, cinema examples, stories of real investors, things that people might want to read. In fact, one of the things we've done is cut a lot of content. So like, we haven't talked about AIF, we haven't talked about PMS, we've not talked about stock investing. It doesn't matter to 95% of the country. We're hoping to have this out in 7-8 languages over the next few years. So, and the proceeds really go to financial literacy for the nation. So the real challenge was make it simple, but also make it interesting, because it shouldn't sit on your shelf.
Okay, no spoilers, but one special story that you can tease from the book.
Oh, one special story that I can tease from the book. Okay, I can't think. You know, there are a lot of great stories of women, and I don't want to sound morbid, who didn't understand money and then went through a life circumstance that really shook them up. And I think those are really heartwarming stories because we've all seen them.
Yeah, and they're so real, right?
They're
because
so real.
You look across the board and everybody knows somebody who might have gone through a tough period, right?
Yeah. So my first copy is going to be gifted to my mother, because despite being an economics graduate, she says money is boring and complicated. So I'm going to give her the first copy, and I'm hoping she'll read it.
What are your conversations normally like if she says money is boring and complicated?
Well, since I've become a mutual fund CEO, she started asking questions. So she's like, can you explain what a stock is? What's the difference between a stock and a bond? So we actually explain what the difference between a stock and a bond in real English is. So she started, but then she gets bored after a while. If she reads this book, I've done well.
Okay, I'm going to read the book. Thank you so much for giving it to me. And thank you so much for joining me in the studio. It's been an absolute pleasure.
Thank you.
All right, that brings us to the end of this edition of MoneyWise. We didn't speak in Latin. And that's partly because I know only a few words, and I'm sure that Radhika does as well. She says she's shaking her head. She says she doesn't know any Latin. All right, but thanks so much for joining in. This is NDTV Profit.